did you? Anything you want.
Spectacular Cunt Report, prepare for a huge 6 months in gold and silver. John Rubino says there's no need to mince words anymore, the gold price is going to spike, and silver will perform even better than gold. No need to mince words anymore. If the futures market still influences gold's price, then that price is going to spike. And silver is better than gold. Since January, gold futures speculators have been trending from extremely bullish to scared short. And in the week ending last Tuesday, the most recent data available, they appeared to capitulate, adding a massive number of short positions while marginally cutting their longs. They're now about as close to neutral as they've ever been. Based on the history of the past decade, this is hugely bullish, since speculators tend to be wrong when they're fully convinced they're right. For the commercials, the banks and fabricators who take the other side of speculators' positions, it's a mirror image. They've been getting less and less short for several months and in the past week took a giant step towards neutral, something that is also historically very bullish. Here's the same data in graphical form, with the speculators represented by the silver bars and the commercials by the red. Convergence at the middle is both highly unusual and highly bullish for gold. Silver is better than gold if gold is set to pop. What about silver? Again, if history is any guide, gold popping means silver rocketing. The reasons for this are fairly simple. Silver is surprisingly rare and extremely cheap. Whereas gold is mostly money, which means we save it after we mine it. Nearly all the gold ever mined is sitting in vaults and jewelry boxes around the world. Silver is both a monetary and an industrial metal. And once used for circuit boards, solar panels and the like, tends to disappear rather than being recycled. So a big part of each year's mine production is lost forever. As a result, available stockpiles of silver have been shrinking for decades. Despite this fact, silver has gotten extremely cheap relative to gold lately. About 10 times as much silver as gold is mined each year, but today it takes 78 ounces of silver to buy an ounce of gold. That means when the next bull market gets going, silver won't just rise along with gold, but will retrace a big part of the gold-silver ratio between 80 and 10. That means it will rise twice as much in percentage terms as gold. And the junior miners are better than the metals. Mining stocks are naturally more volatile than their underlying metals because, as they like to say, they're leveraged to the price of the metals. The junior miners, meanwhile, are hyper-leveraged because of their small size and lack of institutional following, which means if you buy them at the wrong time they fall by 90%. But buy them at the right time and gains of 1000% are common. And there's more. Even if the whole cunt thing turns out to be a dud and precious metals just sit there for another few years, the juniors might still outperform. As the next chart illustrates, big gold discoveries just aren't coming anymore, which means the big miners can't find enough new reserves to replace what they're using up. As commodities analyst Marin Caddison notes, gold miners are running out of gold and they need to replenish their reserves. They'll do this by looking for gold in the markets. They'll go on a buying binge to take out junior gold miners with proven reserves. So either way, the best juniors will be great investments, soaring in long, beautiful arcs on the backs of gold and silver, or in quick spikes when an industry giant buys them out for a nice premium. To sum up, gold is looking great, silver is better than gold, and the junior miners are potentially life-changing. Assuming anyone is still paying attention. Bill Holter, it's time to go back to the basics with gold and silver. After using math, history and logic to argue for gold and silver, Bill says it's time to go back to basics. Here's something every investor needs to know. It is obviously time to go back to basics. I say this based on the emails we've received this week, which ranged from tears to tirades regarding gold and silver price action. While speaking with a friend a few months back, During a period of price weakness, I said tongue-in-cheek that I should write an article titled "We Are Not Your Psychoanalysts." The amount of fear was and is astonishing to me. We have tried to demonstrate with math, logic and history what the ending is. The problem for most is, even if the ending is understood, they want it and they want it now. So, in an effort to help the panicked or despondent, let's go back to the very basics. Below is an image of John Exter's pyramid. You will notice the pyramid is inverted. 100 years ago, this pyramid was inverted but obviously much smaller altogether. What has happened over the last 100+ years is that more and more derivatives of all sorts have been created. Also, promises of all sorts have been made. When I say promises, we are talking about pension plans, health aid, welfare etc. that promise current and future benefits. Basically, via the use of credit and derivatives since the 1970s, asset values have been continually inflated and re-inflated. Without credit and without derivatives, valuations of most all assets would be only tiny fractions of what they are today. The size and scope of the pyramid has gotten larger and larger in relation to the base, gold and silver. Notice that as you go higher and higher up the pyramid, the assets carry more and more risk. It is the high-risk assets that now make up a larger and larger majority of all assets. Thus, systemic risk has continually grown over the years as the highest risk assets are now the vast majority of what society considers assets. As a side note, everything above gold on the pyramid is derived from money, gold, the further away from money, the lesser connection to, think money, value. Looking at the pyramid, the vast majority of assets are promises to pay or perform something in the future. Gold and silver are different, they don't promise anything at all in the future. Rather, theirs is simply a past promise. Gold and silver only promise that capital, labor and equipment was used in the past to create it. This in a nutshell is what gold is all about. It already is pure money and the capital was already expended to create it. It does not need to promise anything in the future, pay interest, to have value today. For example, what value would any debt security have if it promised to never pay any interest? Yes, I know, we almost live in that world now with some debt trading at negative yields, but that only proves the point of insanity in our society today. Look around you, everyone and everything is in debt or has value created by debt. Sovereign treasuries all over the world now have debt to GDP levels that 30 years ago were signposts to being banana republics, and they are the ones who issue what the public considers money. Pensions are woefully underfunded even with asset values at all-time, and unsustainable, highs. Credit is now regularly offered with little to no proof of ability to pay back. Loans have had maturities extended so borrowers could fit into the amounts borrowed. And on the other side, we have seen lenders, investors accept ridiculously low rates from deadbeats because they needed yield. Don't ever forget, the vast majority of what the world now considers assets, require the performance of a promises to perform. When the dust settles, this statement will be wholly obvious to all. Folks, we live in a world of promises that cannot be kept. Where exactly do you believe the capital will flow to when promises cascade into broken promises? It will be the largest transfer of wealth in all of history. Into gold and silver because they don't promise anything at all. Gold and silver are already kept promises that labor, capital and equipment were expended to create them. They are proof of kept promises. These are trying times for those logically holding gold and silver. A financial collapse should have occurred sometime over the last 3 years but has not. Because it has not happened yet is not in any way proof that it will not. In fact, math is never refuted, only delayed. I will leave you with an example. Is there any possible way London has the ability to deliver 3 or 4 years worth of global gold and silver production to their EFPs? It's okay, you know the answer. Yet still worry over current price.